high yield was rolling over and equities warned that divergence wasn't going to last. Was that actually true?
It was true if you look at the S&P 500 and you look at a high yield index, right? I think if you actually look at the corporates, say, that are in high yield, though, and you look at their equities, it's a totally different story, right? So what you see there is that the equities that underlie those high yield companies, so smaller companies, right? A little bit more consistent with the Russell, but when we actually drill down on those exact companies, their equity underperformed, say, the S&P, and actually performed pretty much in line to how you would expect them to perform based on the way high yield bonds were performing.
So, Bradley, does that mean that we don't see any kind of contagion because this was a fundamental move, say, in telecoms and utilities, for example?
Yeah, I do think it was fairly sector-based. I think if you actually look, you do see things like telecoms, you mentioned. There were some issues around healthcare and a little bit around retail that affected the high-yield market. And obviously, the high-yield market doesn't have the big-cap technology stocks, and that's what's lifted the S&P so much.
So, Keith, is this a series of one-offs, particular situations, or is there a broader phenomenon here, at least partially explaining this? And I'll put two things together. One is leverage, what balance sheets look like, ratios simply of debt service to EBITDA, and on the other hand, the possibility of cutting back on the interest deduction for corporations.
I think to Brad's point, you have a difference between large cap investment grade equities that aren't as impacted by this phenomenon versus smaller companies. I think in the interest deductibility question as it relates to tax, if you actually do the math, it's a 10 basis point impact to earnings. It doesn't affect any companies unless your debt to EBITDA is over 6 times. And so that's really not an issue for the S&P 500.
So Bradley,
select companies.
I'm sorry. So Bradley, does this break down roughly along the lines of S&P versus Russell 2000? Because those tend to be the smaller companies?
Yeah, a little bit. And I think, one thing I just add to what Keith was saying around the tax plans, and I do think this maybe contributed to high yield underperforming last week. Our view is that the House plan and the Senate plan have pretty different implications for high yield. And not to get too technical, but basically the House plan and the Senate plan use different definitions of earnings for that interest cap. And because the Senate's plan's definition of earnings is a bit more restrictive, it's going to affect a lot more companies. And you could look at maybe up to a third of the high yield universe affected versus kind of a teens number probably in the House plan. So I do think that potentially led to a little bit of underperformance of high yield. But as Keith said, it has very little impact on large cap, S&P 500 type companies.